Good morning, everyone. The Amendment Bill to the Insurance Act 1938 and the allied acts are expected to be tabled in the Parliament in the ongoing winter session. An overhaul of the legislative framework is expected to enable reform, enhance investment, inclusion of all segments of society, and ensure policyholder protection to achieve the mandate of insurance for all by 2047. Some of the key reforms are increase in FDI. FDI in insurance company is currently permitted up to 74% and is expected that the FDI limit will be increased to 100%, which will fully liberalize the sector. The Government of India has already issued draft rules which simplify conditions for foreign investment, including relaxation on the requirement of majority directors to be Indian resident citizens, higher solvency norms, and 50% of the directors to be independent directors. While majority norms have been relaxed, the chairman or the managing director is still required to be a resident Indian citizen. It will be interesting to see if any new relaxation or conditions are incorporated in the bill. In addition, the government has also announced Cooperative Insurance Service, which would target the cooperative sector to achieve insurance inclusion for every segment of society. The FDI for insurance companies under the cooperative structure may be capped to a lower limit of 26%.
Composite license. It is expected that the bill will introduce composite licensing, enabling life, general and health insurance to be undertaken under one single registration. Composite licensing will be novel to the Indian insurance market, and if implemented, the insurance regulator, the IRDAI, will have to issue new regulations to account for solvency, minimum capital, accounting and investment norms. Composite licensing may lead to consolidation of the market, and policyholders are expected to benefit from simplified policies and claim redressal with lower premiums. Value-added services. Insurance companies may also be permitted to undertake value-added services. Currently, insurance companies are permitted to undertake only insurance business. If implemented, laws on the scope and in limitation of each of the business and mechanism to ring-fence other insurance liabilities from insurance liabilities should be formed. Further, the value-added services should complement insurance business, and it could also be reconsidered that insurance company could distribute financial products similar to bank assurance structures with appropriate safeguards.
Merger of insurance companies. The Insurance Act prohibits a merger of or transfer of insurance business of an insurance company with a non-insurance company. The interpretation of this provision has been much debated in the last decade. It is now proposed that insurance companies can merge and transfer insurance business to a company not engaged in the insurance business. If implemented, this proposal could lead to innovative structures in the market where exits could be provided to investors investing in promoters of insurance companies, and non-insurance companies could achieve backdoor license to undertake insurance business.
Open architecture for insurance agents. Insurance agents are currently prohibited to act as an agent for more than one life, one general, and one health insurance companies. It is proposed that the insurance agents can act for two or more insurance companies of the same class. The IRDAI may have to propose regulations for certain safeguards to avoid conflict of interest when an insurance agent represents multiple insurers.
Higher penalties. The Insurance Act caps the penalties on insurance companies and intermediaries to approximately $1.11 million for each violation. It is proposed to increase penalties to up to approximately $11 million for each violation. It is also proposed to add new penalty provision for misstatements, for which penalty could extend up to approximately $5 million. The higher penalty comes in light of mis-selling to policyholders and to create deterrence for non-compliance with law.
Perpetual license for intermediaries. Intermediaries such as insurance brokers and corporate agents are required to renew their licenses every 3 years. It is proposed that the licenses to intermediaries will be granted in perpetuity, similar to the insurance companies. It will be interesting to see if the IRDAI undertakes a one-time assessment before issuing the perpetual license to intermediaries. And it may also increase inspection by the IRDAI on intermediaries, which is not currently prevalent. Enhanced regulatory authority. It is expected that the bill will give more delegated powers to the IRDAI to ensure effective management of the insurance sector and provide for a protectionist environment for the policyholder.
The overhaul of the legislative framework will be an impetus to set the insurance sector for the next big leap. The future of the sector should be focused on reform, inclusion and development, and the legislative reform will be a stepping stone to achieve that goal.